Income tax. Income tax is money you pay to the government on your wages, investments, or business profits. The more you earn, the higher the percentage of tax you usually pay. For example, if you earn $10,000 and the rate is 10%, you owe $1,000 in income tax. Payroll taxes. Payroll taxes fund Social Security and Medicare, taken out of each paycheck, FICA. Income tax is for the government's general budget based on your total income after deductions. Example, earning $1,000, you might pay $75 for payroll tax and another $100 for income tax, depending on your tax bracket. Sales tax. Sales tax is a consumption tax added to goods you buy, collected by the seller, and sent to the government. Rates vary by location. Example, a shirt costing $10 with a 5% sales tax would total $10.50 taxes. VAT tax is the added value at each stage of production, not the total price. Businesses collect and remit the difference between VAT paid on supplies and VAT charged to customers. Example, a shirt with $10 in materials and $5 value-added labor might have $1 VAT on materials and $50 VAT on labor for a total VAT of $150. Property tax. Property tax is an annual fee levied on property owners based on its assessed value. It funds local services like schools and roads. Example, a house valued at $200,000 with a 1% tax rate would pay $2,000 annually. Estate tax. Estate tax taxes the value of your stuff above a large exemption you leave behind, not your income. Income tax is on your earnings throughout life. For example, if you inherit $1 million, but the estate tax exemption is $11 million, you wouldn't owe estate tax. You'd still pay income tax on your own salary. Gift tax. The gift tax targets transfers of wealth during your lifetime, while income tax applies to your earnings throughout the year. There's a yearly exclusion amount, like $18,000 in 2024 for gifts, so you can give freely up to that limit. Imagine giving your child $15,000 for college. That's tax-free, but your income from your job is taxed separately. Capital gains tax. Income tax hits your paycheck, while capital gains tax is for profits on investments. Sell stock for more than you bought it, you owe capital gains tax. Rates are often lower than income tax. For example, say you buy stock for $1,000 and sell it for $1,200. Your $200 profit would be taxed at the capital gains rate, not your regular income tax rate. Corporate tax. Income tax is for individuals. Corporate tax is for businesses on their profits. Businesses deduct expenses before tax. Imagine a bakery earning 100 calories but spending 60 calories on ingredients. They'd pay corporate tax on the remaining 40 cal profit. Excise tax. Excise tax adds a hidden tax to specific goods like gas or cigarettes, unlike income tax on your earnings. You pay it at the register, often included in the price. For instance, buying a pack of cigarettes might cost $8, but $2 of that could be an excise tax. Import tax. Import tax hikes the price of foreign goods entering a country, unlike income tax on your earnings. For example, a shirt made abroad might cost $10, but have a 10% import tax, raising the price to $11. You'd still pay income tax on your salary separately. Export tax. Export taxes are rare, unlike income tax on your earnings. They tax goods leaving a country, not income. Imagine you sell furniture overseas for $1,000. Most countries wouldn't charge an export tax, but some might. You'd still pay income tax on your profits separately. Fuel tax. Fuel tax adds a small fee per gallon or liter to gasoline, unlike income tax on your earnings. This tax helps fund road repairs. For instance, if gas costs $3 a gallon and there's a 20-gallon fuel tax, you pay an extra 20 cents that goes towards roads, not the government's general income. Sin tax. Sin taxes, unlike income tax on your earnings, target goods seen as unhealthy or vices, like cigarettes. These taxes raise the price to discourage use. Imagine cigarettes costing $5 a pack, but a $2 sin tax bumps it to $7. You'd still pay income tax on your salary. Luxury tax. Luxury tax, unlike income tax on your earnings, targets expensive goods like yachts. It raises the price, often as a percentage. Imagine a yacht costing $1 million, but a 10% luxury tax adds $100,000. You'd still pay income tax on your salary. Windfall tax. Windfall tax targets sudden high profits, not your income. Imagine a war causing oil prices to soar, spiking oil company profits. A windfall tax would tax those extra profits, not the company's usual income. Land transfer tax. Land transfer tax is a one-time fee on buying property, not income tax on earnings. It discourages flipping houses. Example, buying a 200K house with a 1% tax means a 2K land transfer tax paid once, separate from your income tax. Inheritance tax. Inheritance tax hits the value you inherit above a big exemption, not your income. Imagine inheriting $2 million, but the tax-free limit is $1 million. You owe tax on the extra $1 million, not your job earnings. Social Security tax. Social Security tax funds retirement benefits, not your current income like income tax. You and your employer pay a portion of your earnings up to a limit towards future Social Security income. For example, if you make $60,000, you'd pay tax only on the first $160,200 2024 limit, not the whole amount. Medicare Tax. Medicare tax funds healthcare for seniors. It's a percentage of your wages, split with your employer, not taxed on your total income. Earning $50,000 with a 1.45% Medicare tax means $725 goes to Medicare, and you pay income tax on the remaining $49,275. Unemployment tax. Unlike income tax on your earnings, unemployment tax is paid by employers. It funds benefits for laid-off workers. For example, a company might pay a tax on the first $7,000 of each employee's wages to help pay unemployment benefits. Vehicle tax. Vehicle tax, unlike income tax on your earnings, is a yearly fee to operate your car legally. It often depends on factors like engine size or emissions. For instance, a car with a bigger engine might have a higher tax than a fuel-efficient one. You'd still pay income tax on your wages. Registration tax. Registration tax, not income tax, is a fee you pay to register something you own with the government. It's like a one-time startup cost. For example, registering a new car might cost $100. You'd still pay income tax on your wages each paycheck. Occupancy tax. Occupancy tax, unlike income tax on your earnings, is a fee on short-term stays, host rentals paid by guests. It funds tourism initiatives. For example, a $100 hotel night might have a 5% occupancy tax, adding $5 to your bill. You'd still pay income tax on your own money. Severance tax. Severance tax, unlike income tax on your earnings, is a fee on extracting resources like oil or timber. It pays states for what's taken. Example, a company drills oil and owes a tax per barrel to the state, not on worker income. Service tax. Service tax, now replaced in some countries, taxed services like haircuts, unlike income tax on your earnings. Restaurants, salons, etc. paid it. Imagine a haircut costing $20 with a 10% service tax. The salon would pay the tax, raising your bill to $22.
God, please,
You'd still
no!
pay income tax on your salary. Proportional tax. A proportional tax takes the same flat percentage from everyone's income, regardless of how much they earn. Imagine everyone pays 10% income tax. Bill makes $10,000 and owes $1,000, while Maria makes $100,000 and owes $10,000. Unlike a progressive tax with increasing rates, everyone pays the same proportion. Regressive tax. Regressive taxes take a bigger chunk from lower earners. Unlike income tax, the rate stays the same, regardless of income. Imagine a 10% sales tax on groceries. A wealthy person spends more, but the tax percentage is the same for everyone, impacting a lower earner's budget more. Indirect taxes. Indirect taxes raise prices without you noticing them directly, unlike income tax on your earnings. You pay them hidden in the cost of goods, like sales tax, or services, like hotel tax. For example, a $10 shirt with 5% sales tax becomes $10.50. You pay the extra 50 cents, but it's not listed as a separate tax on your receipt. Progressive tax. Progressive tax takes a bigger slice from higher earners. Imagine you make $20,000 and pay 5% tax, while someone making $100,000 pays 20%. The rate increases, progresses, with income, so the wealthy pay a larger share. Securities Transaction Tax. Securities Transaction Tax, STT, is a fee on buying and selling stocks, bonds, etc. on an exchange. It's a small percentage of the trade value. Imagine buying $1,000 worth of stock. With a 0.1% STT, you'd pay an extra $1 on top of the stock price. Customs duty. Customs duty taxes goods crossing borders, unlike income tax on your earnings. It raises the price. Imagine a shirt made abroad costs $10, but there's a 10% duty, adding $1. You'd still pay income tax on your salary. Consumption tax. Consumption tax taxes what you buy, not your income. It's like a sales tax on most goods and services. Imagine buying a shirt for $10. With a 5% consumption tax, you'd pay an extra 50 cents, raising the total to $10.50. You'd still pay income tax separately on your wages. Entertainment tax. Entertainment tax is a fee on amusement activities like movies, concerts, or games. It raises the price you pay. Imagine a concert ticket costs $50, but a 10% entertainment tax adds $5. You'd still pay income tax on your salary separately. Entitlement tax. Entitlement tax isn't a direct tax you pay. It's funded through payroll taxes deducted from your paycheck. This money goes towards social programs like Social Security and Medicare, which you'll be entitled to use later in life. Donations tax. Donations themselves aren't taxed, but it can affect your income taxes. You can deduct charitable donations from your taxable income, lowering your tax bill. Imagine donating $100 to charity and being in a 25% tax bracket. You'd effectively reduce your taxes by $25. There are limits on deductions, though. Promote equality. Treating everyone fairly, regardless of background, is promoting equality. Imagine a race where everyone starts at the same line, with equal access to training and resources. This creates a level playing field for all. Stamp duty. Stamp duty, unlike income tax on your earnings, is a tax on documents like property purchases. You pay it up front when buying a house. Imagine a $200,000 house with a 1% stamp duty. You'd owe $2,000 extra, separate from income tax.